Hello, my name is Kyle McClain, and I'm a partner and senior wealth manager here with Rhame and Gorrell Wealth Management. Today, we're going to be talking about a tax rule that can have a significant impact on Roth conversions, the Pro Rata Rule. If you or someone you know could benefit from an assessment of the Pro Rata Rule's impact on your portfolio or the other services that our firm offers, feel free to contact our team for a complimentary consultation, where we will review your financial situation to determine opportunities for optimization from an investment, tax, estate planning, employer benefits, and retirement strategy perspective. So without further ado, let's dive into today's topic, the Pro Rata Rule. Converting assets from a traditional IRA or 401k to Roth can offer tax advantages. However, it's essential to understand the effect of the Pro Rata Rule in relation to these conversions. So what is the Pro Rata Rule? The Pro Rata Rule applies when a traditional IRA or 401k contains a mix of both after-tax and pre-tax funds. These after-tax dollars often originate when a person makes a traditional IRA contribution when their income prohibits them from receiving a deduction. But there are other possible circumstances that may cause the Pro Rata Rule to come into effect. Each dollar withdrawn or converted from such an IRA or 401k will contain a percentage of tax-free and taxable funds relative to the proportion of those funds that make up the account. The Pro Rata Rule is used to provide a ratio that determines what amount of this conversion or withdrawal is taxable. This ratio is calculated based on the percentage of non-deductible dollars within the traditional IRA, SEP IRA, simple IRA, and even some types of 401k accounts belonging to the individual. It's important to note that the Pro Rata Rule treats all IRAs as one IRA. This is referred to as the Aggregation Rule. Opening a new IRA account and making a non-deductible contribution does not avoid this rule. Let's start by diving into how the Pro Rata Rule works with Backdoor Roth IRA conversions. A Backdoor Roth IRA conversion involves making a non-deductible after-tax contribution to a traditional IRA account, and then subsequently converting those funds over to a Roth IRA account. If an investor already has a pre-tax contribution in any other IRA and attempts to execute a Backdoor Roth conversion, the Pro Rata Rule will create a tax liability. Let's take a look at an example. Let's say Stephen currently has a traditional IRA. Over 5 years, he has made tax-deductible pre-tax contributions to this account in the amount of $28,000. Now, after exceeding some limitations for the IRA deduction, he is looking to take advantage of Backdoor Roth conversions and makes a non-deductible contribution of $7,000 to his traditional IRA in hopes of undertaking a Roth conversion. When he makes the Roth conversion of $7,000, 80% of that amount will end up being taxable since he already has a deductible pre-tax contribution in the IRA. The Pro Rata Rule can also apply to other non-IRA situations. The Pro Rata Rule frequently comes into play within an investor's 401k when executing a Mega Backdoor Roth conversion. When an employee has maxed out their pre-tax 401k or Roth 401k and still wants to put money into their workplace retirement account, certain plans allow for a contribution to the after-tax account within the 401k. This rule becomes an issue for Mega Roth conversions when there is taxable growth on those after-tax contributions before such after-tax balances are converted or rolled over to Roth. Here's an example. Let's say Stacy's salary is $250,000, and she's currently maxing out her pre-tax 401k contributions at the maximum of $23,500 for 2025. Her employer matches 100% of her contributions up to 6% of her salary for a total of $15,000. The total amount going into Stacy's pre-tax account from her contributions, as well as the employer's contributions, is $38,500. For 2025, the IRS allows a maximum annual addition into any type of defined contribution plan, such as a 401k, to be $70,000. This leaves $31,500 that Stacy can still contribute to her 401k plan if she'd like. Since she's already maxed out her salary deferrals in her pre-tax 401k, she can put this money as a contribution into the after-tax account. This after-tax account is where the Pro Rata Rule can come into play. Let's assume Stacy puts $30,000 into the after-tax account and it grows to $40,000. This $10,000 of growth is viewed by the IRS as pre-tax dollars. This is an issue because now Stacy has a non-taxable contribution basis of $30,000 as well as taxable growth of $10,000 in the same after-tax account. The $10,000 of growth will be realized as income when a Mega Backdoor Roth conversion is made. Therefore, it is generally best to make Mega Backdoor Roth conversions before growth in the after-tax account occurs to avoid this problem arising from the Pro Rata Rule. By now, we hope it's becoming clear that the Pro Rata Rule can be a serious pitfall for uninformed investors. Let's talk about methods for avoiding the Pro Rata Rule. In order to avoid the Pro Rata Rule, all pre-tax dollars must be removed from the account. For IRAs, the best way to accomplish this is by rolling the pre-tax funds into your current employer's retirement plan. Now, not all 401k plans will allow inbound rollovers from IRAs, but it is the cleanest solution for those seeking to execute Backdoor Roth IRA transactions. Once your traditional IRA is empty, investors can complete ongoing Backdoor Roth conversions without incurring a tax liability arising from pre-tax IRA dollars. For Mega Backdoor Roth conversions within a 401k, potential solutions are far more sophisticated. In some cases, a pro rata rollover of the funds in the after-tax account to outside IRAs may be involved. Similar to the previous situation, this is only available within certain 401k plans and requires careful supervision for successful completion. It's also worth noting that if you do pursue a pro rata distribution of your after-tax 401k account, it could potentially complicate future Backdoor Roth IRA conversions. These transactions are incredibly complex from a tax standpoint, which is why we strongly encourage you to consult a tax professional, such as one of the CPAs on our team, before acting on any of the strategies discussed in this video. At Rhame and Gorrell Wealth Management, we provide advice on over $1 billion in client portfolios. And as a firm, we strive to serve as an effective one-stop shop for comprehensive retirement planning. The many CFP and CPA tax professionals on our staff specialize in helping our clients take advantage of advanced financial strategies to materially enhance their financial ability to enjoy their lives, both before and after retirement. We invite you to schedule a complimentary consultation with our team by giving us a call, sending us an email, or simply visiting our website today.